When looking at returns, Penrose says that future value of every investment is a function of its present price. The higher the price you pay, the lower your return will be. You need to take into account certain factors, like you need to consider inflation and taxes, and profit should be measured after taking these into account. You need to know that business cycles are inevitable. If you're currently in a bull market, know that a bear market is around the corner, and that is where the value investors should take advantage. You should expect fluctuations, and timing does not matter. You leave worrying about market fluctuations to the speculator. Investors should be more interested in obtaining sound securities. What you're looking at in a company is its long-term prospects, its management quality, financial strength, capital structure, dividend record, all the things mentioned in the previous slides. The investor with a portfolio of sound stocks should be expecting the prices to fluctuate and should not concern himself with sizable declines or become really excited with sizable advances. Investing is not about beating others at their game, it is controlling yourself at your game. Here's a graph. We are looking at inflation and comparing that to the stock market annual growth rate. And as you can see, stocks generally do bad with low inflation. With moderate inflation, they do well, and high inflation is usually worse. It's kind of erratic. The highest returns are usually with inflation being around 2 to 3%. Margin of safety. Risk can be changed, but not eliminated. No matter how careful you are, you cannot eliminate the risk of being wrong. That's why Graham insists on keeping a margin of safety. This just means that you buy at a big enough discount to allow some room for error in your estimation of value, and it helps to pad potential losses. It can minimize your odds of error. This question, he argues, will give people the courage to keep the rest of their money in stocks even when the stocks sink. You can't just focus on getting your analysis right. You must also insure against loss if your analysis comes out to be wrong. Other things you can do to protect is diversify. Another quote, there's a close logical connection between the concept of a safety margin and the principle of diversification. For the margin guarantees only that an investor has a better chance for profit than for loss, not that loss is impossible. On the same principles as before, he says the secret is you. You need to be a critical thinker and not take the market on faith. Keep a contrarian approach. Use the dips in the market as points to acquire more of quality stock, along with finding new opportunities for suitable investments. Interpret, don't just follow. You need to develop your mindset. You can't be impulsive or let emotion get in the way of rationality as created by value investing theories mentioned before. He says in the end, how your investments behave is much less important than how you behave. Another wise comment by Warren Buffett, be fearful when others are greedy and greedy when others are fearful.